Former U.S. Federal Reserve Chair Paul Volcker slayed inflation. Ben Bernanke saved the banks. Can current chief Jerome Powell do both? Well, that is the need of the hour, according to many. The current banking crisis threatens financial stability while inflation threatens to push ahead. And that is not restricted to the confines of the U.S., but risks spreading beyond its borders.
At first glance, the Fed, under Powell's leadership and other major central banks, continued this week with the same policy that they've had in place for the past year, which is to raise interest rates to bring down inflation. In reality, however, everything is different now that a series of bank failures has sent tremors through global financial markets. Threats to financial stability were not even on the radar of central bankers until recently. Now they're shooting for the stars. To hear Powell and his colleagues tell it, avoiding another round of inflation like the one experienced in the 1970s is still job one. But the signal is shifting. That is warranting a policy similar to what Ben Bernanke used during and post the global financial crisis. Bernanke fought off the 2008 crisis by adopting unprecedented methods, including doling out free cash to banks, literally. After Silicon Valley Bank failed and Credit Suisse had taken over by a shotgun marriage, the Fed only raised interest rates by half as much as was anticipated. The European Central Bank and the Swiss National Bank hiked as expected, but they refrained from providing any forward guidance. The recent wild swings in market bets on policy show that investors, too, are having a hard time figuring this out. After SVB's failure, they shifted from pricing in an aggressive Fed that hikes several more times to pricing in a "we're all doomed" scenario of imminent rate cuts, and are only now slightly less pessimistic. Analysts say the core dilemma for policymakers is that prescriptions for controlling prices and boosting banks point in opposite directions. To get inflation down, central banks jack up rates. They give money to struggling lenders and lower the cost of borrowing to avert crisis. And the danger is that they end up with the worst of both worlds. A full-blown crisis that triggers a recession. Then that would force central banks to give up the fight against inflation before it is over. So what remains to be seen is, have the predictions now turned for the worse or the better? A softer tone or an aggressive one will define the path the world's largest economy takes.